Hey, it's Jeff Cameron with Keller Williams. Thanks for tuning in to my series on before foreclosure and short sale. What are my options? Today we're talking about option one, or step one, which is how can you save your home. There are basically four different ways that you can, or different methods that you can save your home. Number one is pay off and refinance. And I know that one sounds simple, but sometimes you've got to think about it and explore it. One of them would be if you had an opportunity to find funds through family or through a hard-money lender or something like that to pay off the mortgage and no longer be in the situation you're in, or to look at any type of refinance that might be available to you out there. And one of those refinances is in the HAMP program. We'll talk about that a little later when we talk about loan modification and put those all together. The second choice would be forbearance. Now, forbearance is just really a way for you to catch up on your mortgage. It used to be that once a bank once you're 3 months behind on your mortgage here in Arizona, they put you in foreclosure. Once you're in foreclosure, they won't accept any money except the total amount of funds that you owe in order to become current. Well, that can be really difficult for someone to come up with. Say your payment's $1,500 a month, you're down 3 months, and the new first of the month's coming. In order for them to accept that payment, they would want the full 3 months times $1,500, and plus the new month, 4 months, $6,000. Well, a lot of people in today's world, coming up with $6,000 is just impossible. So what the banks have become a little more forgiving and easier to work with. And so in a forbearance, what they do is, in that same example, they'll take the $4,500, divide it by, say, 6 months, and so that gives us a number of $750 a month. And you'll make those payments on top of your regular payment. So if your payment's $1,500 and you're paying that additional $750, your payment now becomes $2,250. You'll pay that over 6 months until your mortgage is caught up. And at that point, you'll go into the possibility of any type of modification. But that's the forbearance, and that's to get you out of foreclosure and keep your home. The third option would be to do a loan modification. And again, as I mentioned a minute ago, a lot of people think they're in a loan modification when really they're in a forbearance. And the banks will title those trial period. Well, the trial period is usually getting you caught up on your mortgage. So what is a loan modification? What does it really do for you? Loan modifications there are three different things they can do. One is to lower your interest rate. One would be to extend the time till your next adjustment. That's where a lot of people were nervous. You know, I'm in this house, but it's adjusting in 2 years. Rates are going to be higher in 2 years. Oh my God, what are we going to do? And then the third thing would be to do a principal reduction. So far, we have seen no principal reductions, and there's starting to be some rumblings about it in the press. I just don't see that happening, but who knows? You know, there's a lot of things that have happened that I didn't see happening. So let's get back to those two. Mainly what they're doing is they're reducing your interest rate from whatever it is to 5%, or right about 5%. In some cases, I've seen them lower folks' interest all the way down to 2%. So negotiate with your bank on that process. With all of these processes, you want to get a hold of your bank right away and stay in dialogue with them. Sometimes just by talking to them, they'll stop the foreclosure process and hold it off. Do realize when you get on the phone with them, they're going to ask you every time for a payment, and just stay steady. If you don't have the money, don't give them the money. So on the loan modification process, you're looking at extending the time till your next adjustment. What I've seen is a new fixed rate today that lasts for another 5 years until the next adjustment, and I've seen the interest-only part going out 10 years. They want to keep you in the house too. And then the other process would be, that's your time frame, the other process would be lowering the interest rate. For a lot of people who let their loan adjust, fully adjusted, a lot of the loans went to 3%. And for some people, that's actually a better avenue right now. Keep it at 3% for a while as the market starts to regain some strength. Now look at getting in a loan modification and putting it at 5. You can save a lot of money doing that. The HAMP program, talked about that a little bit in the very beginning when we talked about refinances. HAMP is the Home Affordability Modification program, and there are two different things you can do there. One is a loan modification, and the second is a refinance. So let's touch the refinance real quick. The refinance is for folks that have been current on their mortgage, and they owe up 125% of the value or less. So in the HAMP program, you can refinance your house if you're current on your mortgage and have been for the last 12 months, and you owe, say, 120%, which would mean on a $300,000 loan, if you owe $360,000, the house is worth $300,000. I said loan a minute ago. $300,000 value of the home, you owe $360,000. They'll refinance that for you. You can owe up to $375,000 in that example, and they'll refinance you. Let's see, what else with the HAMP? It has to be a 1 to 4 family property, and it has to be an owner-occupant. So the last possibility would be a short refinance. Now, with short refinances, there's 2 different ways to do them: when you're current and when you're behind. There's some companies out there. I have one on my website. You can watch their video. It's called M3 Strategy. What they do is they work with people that can qualify for a new mortgage, and say somebody owes $500 on a house that's worth $300. They negotiate with the bank for you. They get the bank to accept a lower payoff, which actually nets them more than they would get in a short sale and much more than they would get with a foreclosure. So that's the bank's motivation. They then have you refinance into a new mortgage, and they usually make a spread between what the bank is willing to, that they negotiate with the bank, and what your new mortgage is, and that's how they get paid. The second way is with folks that have been behind, and a lot of people have been behind, so they can't qualify for a new mortgage. There are some companies out there with some hard money loans, and they're going to be a higher interest rate. You're probably looking at in the 7s, but actually 7% or 7.5%. It's not miserably high. You know, that's more of where rates have been traditionally as a norm. Is there a norm? They're fluctuating all the time, but as an average. So in that situation, again, they negotiate with the bank to take a lower payment. There is a little more motivation with the bank at that point, because they know otherwise you're going to be a short sale or you're going to be a foreclosure. And the studies are now out at the numbers. How much money are they getting on average on a foreclosure, and how much money are they getting on average for a short sale? So they know all those numbers, and that's why they're willing to do stuff like that. I've got a company I've been in touch with. I haven't quite videoed them yet. I hope to get them on video and on our blog regarding the hard money short refinances. So there you have it. Before foreclosure and short sale. Option 1, how do I save my home? Either get that, pay off that mortgage or refinance, do a forbearance, getting caught up, do a loan modification, lowering your interest rate or extending the time for that adjustment, or lastly, doing a short refinance. I hope this helps you. I hope you can save your home. And if you can't, the next videos are going to be about whether or not, before foreclosure and short sale, are you protected? Is there recourse? Can the bank come after you? And will the IRS be able to come after you if you are 1099 for a loan that they took less money on? So really important stuff for you to know before you make your next decisions. This is Jeff Cameron with Keller Williams. I hope you're finding a lot of value here. By the way, if you know someone that can use this video, please email it over to them. Share it with them. 480-502-7699, jeff@thecameronteam.com, here in Scottsdale, Arizona, serving the Metro Phoenix area.